Okay, thanks for tuning in today, guys. We're just going to wait one more minute and then we will kick in to today's webinar. If you are just jumping in, there is a chat box down the bottom there or a Q&A box. Just want to make sure everyone can hear us as well. So if you can hear us, feel free to drop a comment in the chat box or drop a question or raise your hand or anything like that, just so we know that you can all hear us. Thank you, Robert. That's great, mate. Thanks, Tony. That's great. Thank you, Chris. That's good. Lovely. Always great to know that technology is working. Okay, we might jump into it. So welcome, G'day Expats, to today's webinar where we are going to focus on the outlook for 2025. We're going to touch on some key trends and insights for the year ahead. I'm joined by my co-panelist and host, Ben Turner, who is the Managing Director for our Atlas Taxation arm. We've also got Jeremy Harper, the Managing Director for our Atlas Mortgages arm, and I myself, James Ridley, I'm the Managing Director for the Atlas Wealth arm on the APAC side. We'll move into the slides today. And I guess before we kick into it, just a bit of short housekeeping. Because we are on Zoom, sometimes we're on GoToWebinar. If you do have a question as we move through today's session, you'll notice there is a bit of a Q&A box down the bottom. So feel free to drop in your question. You can submit it anonymously or you can submit it just as yourself as you come into Zoom. We are going to have a bit of live Q&A at the end and then we'll move on to it. The recordings will also be available and a copy of the slides will be sent out in the next 24 to 48 hours. As we move into the next slide, a bit of a disclaimer. So whenever we're doing a webinar, we love to have a disclaimer. So anything you see or hear today should not be taken or construed as personal advice. Anything you hear or see today should just be assumed as information or educational, sometimes entertainment purposes only. If you do require advice or an assistance, please seek out the appropriate professional, such as a tax accountant, a lawyer, a mortgage broker, or a qualified and registered financial planner. So who is the Atlas Wealth Group? Well, we're the leading provider of Australian expat tax, financial, mortgage and asset management services. We are regulated by ASIC, the ATO and the DFSA. And as we continue to grow, I'm sure there'll be more acronyms in that one. We have clients in over 50 countries. We manage over 300 million in assets and all of our specialists are degree qualified with numerous postgraduate certifications. Today's agenda and what we're going to be touching on will be a bit of a market and economic update. That'll be coming from myself, a bit of a tax update coming from Ben Turner, and then Jeremy's going to give us the lay of the land on the mortgage and lending landscape back in Australia at the moment and where interest rates might be going as well. And then we'll finish off today's session with a bit of Q&A. So if you do have questions, please make sure you do get them submitted just so we can address them. Put us on the spot today. We'll do our best to address them and run through it all. Now, kicking into my section for a bit of a market and economic update. So 2024, how did we go? This is obviously a quick graph here of the ASX 200, which is a great read on the Australian share market. The 2024 calendar year was a pretty steady year for the Australian share market. We can see there it finished quite up. We did about 8%, just over 8% for the 2024 calendar year. And there were some standouts within the Australian share market sectors. The biggest and the main three were actually technology, remarkably, in Australia. 52% actually outperformed the Australian tech sector in the US. However, the Australian tech sector is tiny when it comes to our share market. Financials did really well in Australia, 34%, and then the other best performer sector in Australia was consumer discretionary. Funnily enough, the worst performer was the energy sector, which is a large portion of our market cap. It felt the most pain. It was down negative 21% for the 2024 calendar year, and a lot of that was driven and sparked by market concerns and falling demand amid slowing global economies. If we compare ourselves to the US share market, the US share market did remarkably well, 23%. If we look at the last 2 years, 2023 calendar year, 2024 calendar year, we've had a really strong 2 years. 2022 calendar was terrible, especially for the US share market. It actually finished down negative 20%. So really getting some cadence now on those two back-to-back calendar years. When we look at this graph, I believe it does tell a very interesting story. And the reason I say that is our market caps are very different. The US share market, especially the S&P 500, is dominated by the tech sector, especially the Mag 7 or the Magnificent 7. So those are your common tech stocks. They make up more than 25, it's closer to 30% of the S&P 500, if not more. So when you've got those techs really dragging up that index, a lot of other shares get dragged along with it. We had that very strong theme of AI last year as well, and the US share market did very, very well. The Australian share market did well, but obviously we're not made up a very large tech at all. I think the tech sector in Australia makes up less than 10% of our market cap, so it's tiny. But remarkably, the Australian tech sector did really, really well. But unfortunately, whenever a tech company in Australia gets big enough, it heads over to the US. How did the Australian dollar perform relative to the US dollar? I would say there was a very small key theme where it was trending up. It was trending up as we moved throughout the year. Very small theme there, very slight. But then when we hit September and Trump was back, the Australian dollar did pivot. It then obviously headed south. And I mean, there's a few reasons for that. There was a bit of a hawkish pivot, especially by the Fed versus the RBA. There were concerns about the outlook, especially for iron ore prices. Australia's or the Australian dollar and our currency, two key drivers are interest rates in Australia and also commodity prices because we are a net exporter. So when our commodity prices have fallen through the fall and they've been rather depressed for the last 12 to 18 months, and you've got one of our major export partners such as China struggling, it does mean that a lot of our partners or export partners don't need to hold large amounts of Australian currency. And obviously that weakens our currency further. So we are weak at the moment. If we're trying to think about what 2025 calendar year holds for the Australian currency, well, I think it'll be stuck between 60 cents and US 70 cents. I think the risk will be skewed to the downside, so more downside to US 60 to 65 cents, just because we, I suppose, don't have clear indications just yet of what Trump's policies will be, the tariffs and what that's going to mean for us. We know they're coming. That's what he said in his inaugural speech. So we're not sure what shape or form that means for us, but we'd expect that the Australian dollar will still remain weak against the US dollar this year. Some key themes from 2024, and a lot of these are known. We saw stronger than expected growth and profits. This was despite high interest rates, China worries, and weak conditions throughout Europe. Global divergence. US growth was strong, yet Europe and Japan rather soft. Further disinflation. So we're seeing inflation coming down across a lot of the major countries right now, including Australia. It's fallen from its peaks of 8 to 11% down to 2 to 3% right now. We'll see what the February decision is going to be from the RBA. Interest rates have fallen throughout the world except for Australia, but we'll let Jeremy give us an update on that shortly on when that might be. Geopolitical threats as well. They failed to dent investment markets. We saw a lot of that throughout the Middle East and the impact that we all thought that was going to have on a surge on oil prices, but it didn't have too much of an impact at all. And it seems to be calming down now. So we'll see what this year brings. And what that means is that when we look back at 2024, share markets had a lot to consume. There was a lot of key risks there. Recession was also evident, but nothing really took off and nothing really happened there. And share markets still performed rather well, especially the major one being the US, which now dominates 75% of global share markets, which is significant. What does the 2025 look like for the US? Both the market and the economy. So I've tried to break this down into some categories here. So economic growth, well, the US expected to grow 2%. So that's its GDP, its economy expanding. 2 to 3% is steady. And so that's not something that would concern us. When we compare that to a country like China, China's usually targeting 4.5 to 5%. So 2% is okay. We're not seeing negative there at all. Inflation, core PCE inflation projected to approach the Fed's target of 2%, which is good. Interest rates, gradual rate cuts anticipated for the US, with the US federal funds rate likely reaching 3.25% by the end of 2025, but we'll see what Trump does there. Trump's policies, so stimulus measures, tax reforms and deregulation expected to boost growth in domestic and cyclical sectors. Key risks following Trump's administration will be the tariffs and his immigration restrictions. Could lead to stagflation, slower growth and higher inflation, that means. Potentially prompting the Fed to consider rate hikes if the economy weakens. That's just a risk. Not saying it's going to happen. It's just a risk for 2025. Policy implications. Yep, inflation risk could still be evident. This assumes the administration will avoid policies that exacerbate inflation. Trump did get in on cost of living and trying to obviously stamp out inflation because voters did signify that they're very dissatisfied with the Biden administration when it came to that. Tariffs and immigration, yep, likely to be implemented cautiously to limit inflationary pressures. Myself, Jeremy and Ben were just talking about this before today's session, what it's going to look like, because there was an interesting article that came out of the Australian Financial Review in the last couple of days. Business confidence, supportive policy mix expected to bolster confidence, drive capital markets, as well as benefit private asset performance. So reading the tea leaves from that, I would say it's going to shape up pretty good. It's not going to be, I suppose, a massive year in share market returns, but I think it's going to be a steady year, and there's still going to be plenty for investment markets to consume, and I think volatility will always remain. What about the global markets and the global economy? Well, there's going to be headwinds. There's going to be policy divergence as well. Europe, growth under pressure from trade policy, uncertainty in tariffs, ECB likely to cut deposit rate to 1.5% by year end to counter that stagnation, especially in Germany. UK still struggling. I believe their unemployment rate's ticking up. It's nearly over 5%, which historically is okay. It's close to the average, but they are ticking up. They're still struggling a bit there with low productivity and labour constraints. Bank of England, base rate expected to decline slightly, but we'll see if that helps the economy, but not going to see too many signs of life out of the UK this year, I would say. Japan, strong wage price dynamics anchoring inflation near 2%. The Bank of Japan may raise rates to a 30-year high of 0.75%. It's remarkable that 0.75% is a 30-year high out of Japan. I know I've seen so many people heading over to Japan for holidays right now because the yen is cheap, but remarkable that 0.75% as the cash rate is considered high. China's always facing property issues right now. They just keep building things. They've got, I think, last time I checked was over 95 million empty apartments. Facing property market collapse, deflation, and the US tariffs. Australia doesn't need China, so we'll see if they make some further reactive policies to assist their local economy over there. GDP growth expectations are still below the expected 4.5% for 2025. They are a big economy. They can do a lot, to be honest, in 12 months. But we're always keeping a very close eye on China because Australia does need China. What about back home in 2025 for Australia? So our economy, gradual recovery expected this year after the slowest growth we've had in 32 years for 2024. We didn't slip into a recession, but I think Jeremy and I, we said a few times on the Expat Mortgages podcast that we were in a recession per capita. So that was plenty. That was broadcasted in plenty of different news outlets. Key drivers for the recovery this year: rising real household incomes as inflation eases, rebounding housing market. Now, when I talk to clients about that, sometimes they look at, let's say, capital cities in some areas and say, these places are still, performing really, really well. So, yep, this is just mainly looking at the average. As interest rates come down, we'd expect the housing market to do a lot better. Jeremy's going to talk a little bit about that shortly, as well as interest rate cuts boosting some momentum there. And then what about Australian equities? Well, we'd expect moderate returns. We expect supported by changes in US policies under the Trump administration. Whilst tariffs are a key risk, we would expect that Trump would be rather friendly to his neighbours, such as us. We don't do too much business formally with our exports and those sort of things with the US, but we expect that Trump would be rather friendly to Australia. Key opportunities, our resources sector, so potential rebound. Again, it's been depressed for the last 18 months. Value dispersion, so significant differences across different sectors within Australia does present opportunities. AI adoption, so productivity gains, driving growth using generative AI to boost productivity. When we look at our share market and compare it to the US share market on a valuation hypothesis, so the ASX 300, that's just a different index in Australian share market, but our price to earnings ratio is 20 times and the yield 3.5%, very pretty standard within the Australian share market, but we compare that to the S&P 500 in the US, that's 26 and the yield's 1.3%. So our share market is a lot more attractive. It's a bit of a standout in terms of value at the moment, whereas the US share market is a bit expensive. I don't think anyone would disagree with that. It also means that the US share market is probably a little bit more sensitive to share market shocks, just because it's a little bit more expensive than other share markets, whereas other international share markets, Europe, FTSE 100, they haven't seen the same kind of growth, so they're much better value at the moment. So all that means is whenever you're considering your own portfolios, diversification is key. China stimulus, Australia's poised to benefit from Chinese economic support measures. We hope so. Economic support, low interest rates, population growth, and a resilient economy to provide some tailwinds for the Australian share market. Some reasons for optimism, and I think a lot of these key themes will ring true this year. Inflation, it's going to keep trending down as labour markets continue to ease, demand eases, and commodity prices ideally remain depressed. Central banks to continue the rate cutting theme. Global growth is likely to slow, but only to just below 3%. And then lastly, if recession does occur, it's likely to be mild. Absolutely. Trump's policies on tariffs will create a lot of uncertainty and disruption. Trump's first term does tell us that he ultimately wants to see share markets up. He doesn't like taxes and he likes seeing shares up. So I dare say Trump is good for share markets. So we'll see what plays out over the coming years and this year and what his policies will look like. That's all from me right now. I'm going to hand it over to Ben to give us a bit of a tax update. Over to you, Ben.
Thanks, James, and good morning or evening wherever you are in the world. The first slide I'm going to talk about is relevant to anyone who's got an Australian-based property, be residential or commercial, located in Australia, if you're non-resident at the time that you're selling, non-resident for tax purposes, that is. If you could just advance to that first slide there, thanks, James. So to give you a recap on what foreign resident capital gains withholding is, if you sell a property and you are non-resident at the time of sale, then the ATO, through your conveyancing process, says we're going to withhold a certain fraction of that sales price to anticipate the tax that's likely to be due through the capital gain on that property. Now, the capital gain is not always the amount that's withheld. Often it's less or more, so that there's ways to manage that, but there is a specific percentage that the ATO has specified as being 12.5% of the sales price. That has been the rate historically. From 1st of January this year, that has bumped up to 15%. So on $1 million sale of a property, $150,000 is set aside and sent to the tax office as a provision for future capital gains tax on that property. So that was the change from 1st of January 2025. The second part of that change is there used to be a de minimis that was associated with this. So any property that was less than $750,000 in sale price didn't have to have this amount withheld. That has been removed. So regardless of the sales value, this foreign resident capital gains withholding amount needs to be set aside through that conveyancing process and paid to the ATO. Now, when you lodge a tax return and go through the process of working out the actual tax, there may be an additional payment if the amount wasn't enough, or there may be a refund if they've over withheld. So it does create some problems though, in the sense of, say you've sold a property on 1st of July, then you're waiting maybe 18 months before you get any refund back through the tax return process. So there are some things you can do in that instance. You can pre-calculate the capital gains tax that is applicable to your property, and if it's less than the 15% that they've specified you need to put aside, then you can submit a variation form to the ATO, and they can look at your situation and agree if the amount should be less than 15% and what amount they should set aside instead. Sometimes there's a few different variations you need to do on your tax return just because there might be the odd expense that you hadn't incorporated at that time. That's fine, but they get you around the mark, and that can be a really great benefit to making sure that they're only putting aside the necessary tax associated with the property and not the 15%. A few key points with this though: the timing of the capital gain is when you sign the contract. It's not settlement date, so bear that in mind. It's when you sign the contract. If you are a tax resident at the time of signing the contract, then this doesn't apply to you. So in that case, you can apply for a clearance certificate, and that's something that conveyancers are all very aware of, which says I'm a resident, this doesn't apply to me. They're really looking to capture those people who are non-resident, who are more likely to be a flight risk for their Australian-based tax. The variation that I talked about, you do need to be a little bit organised with that, because you'll often have a situation where if you've got, say, a 30-day settlement, the ATO has a service period on these requests of 28 days, and they require a signed sales contract. So say you signed a contract via auction on day one, you would need to be pretty organised to submit the variation request based on that contract, have that approved to the ATO within the 28 days, and then submit that to your conveyancer so they can reduce that amount down. So I would encourage you to either push out the settlement date to give you a bit more leeway, or get onto it pretty well straight away. Look, we do have some good instances of the ATO expediting cases where there is minimal time, so we can still work with those if possible, and we've had some great results we've been able to get for some clients, so bear that in mind. I don't want you to think that it's all doom and gloom. We can try and expedite claims if there is all information available to us, but you also need to have your tax returns up to date as well. If you've got historical tax returns not lodged, then that is a problem. You need to get them up to date before they'll approve that variation. Next, we will talk about the help indexation adjustments. So this is something that's been going on for a couple of years now, but it's taken quite some time for it to be legislated. So we're just seeing this come through now. So as a recap on that, for those that had a help debt on 1st of June 2023 and 1st of June 2024, when they do the indexation to all HECS help balances, what used to be the measure of the amount that they would index that was always the CPI, but the last couple of years has been pretty high, but wage growth has been pretty low. So there's been this argument to say CPI is not the best measure to consider that. So the government legislated that we're going to use the lower of those two amounts, the CPI wage price index. And what that meant for those historical indexations in 2023, which was 7.1%, and in 2024 it's 4.7%, they've moved to the wage price index amount of 3.2% and 4% for those 2 years. And what that's meant is that anyone with a balance in either of those years or both of those years will have an adjustment that's gone through their help account. So that has all been processed now, and so if you log into MyGov, you'll see those balances updated. If you have paid your debt off in between now and then you'll actually get a credit for the amount that you should have paid instead of what you did pay. So what the ATO will do though is they'll offset any outstanding debts you've got with the ATO first, and then if there's any amount left over, they'll issue that credit back to you. So you should be able to see that through your ATO pre-fill. There's nothing you need to do in order to activate that, but you may see some correspondence from the ATO in relation to that. If you're unsure and you're a client of ours, you're welcome to reach out. We can give you some more information. Unfortunately, there's been no changes to the residency rules. So just to recap on this, there is an overwhelming support by both sides of government to change the residency rules for individuals to make something a little bit more ascertainable for the regular people trying to work out if they're resident or not. But that has gone through quite some process over several years, where we started off with a report, then there was change of government, then there was a consultation on the report with questions asked. Now, the last action on that was September 2023, so we're almost 18 months from that date, and there's been no news or updates since that particular point in time. And now we're facing an election which is likely to be in April or May this year, and depending on where this sits as a priority for the government may dictate whether or not we see legislation in the near future or not. From what I'm hearing, though, there's a lot of murmurs around this being a key issue. There's a lot of talk about cost of living pressures and the cost of housing and things like that. So I do expect this to perhaps sit on the back burner for a little while. So I guess the key takeaway there is that it's business as usual as far as the residency rules are concerned. Whilst the Board of Taxation report, which specifies in that, potentially using a 45-day rule, you need to be aware that that is not the law. It is, yes, perhaps a bit of a test to sort of see where the minds of some people are at as far as what might trigger tax residency, but it's not it's not the legislation, it's not the way the residency rules work at the moment. So you do need to consider the residency tests based on the current rules and applying each of the 4 tests to see whether you're a resident. If you are unsure of your residency position or your circumstances have changed, please link in with us. We're happy to give you some more clarity on that. Okay, so I'll move on now to Jeremy for an update on mortgages and lending.
Well, thanks, Ben. Thanks, James. Good morning, good afternoon, everyone. Thank you for your time. I'm just going to give everyone a little bit of an update on 2024, the year around lending, where rates are at and where property was or how it performed throughout the year, and maybe some of the policy and trends that we could see in 2025. So if you just jump across the page, thanks, James. So this is what everyone's talking about, every barbecue, every breakfast table around Australia. Where's the cash rate at and where's it going? 4.35. I think it's pretty fair to say everyone, or the market was definitely expecting a cut to come through November. It didn't materialise. So what did that do to the market? Well, from my point of view, typically you see a very busy Christmas buying period just before, throughout December. The last couple of weeks of December was a little bit more subdued as it became a bit more of a buyer's market. Definitely flipped throughout the year from a seller's market start into a buyer's market. And so we didn't see that manic rush leading into Christmas as buyers sort of sat on their hands, partly because there was more stock available, partly because that first rate cut didn't materialise. But we're starting to see January, people are starting to still buy property early in the year. So traditionally people wouldn't really transact on a property before Australia Day to the end of January, but we're starting to see that filter through earlier this year. And so if we just turn the page, what did that do to the property market? So as James mentioned earlier, on a combined basis, property did 4.9% annualized growth last year. So the equity markets did outperform on a whole. But if you look at on a metro or a capital state or capital city point of view, and you drill into, say, Perth, Adelaide, Brisbane, they definitely had strong double-digit growth throughout the year. And then if you see Melbourne and Sydney were sort of lagging some of those smaller cities. And so if you look at the RBA group, they had a update to the market just recently saying that throughout 2024 there was a 7.9% increase in listings across the country. So that's supporting the fact that there's more stock available for buyers, which was sort of holding back some of that growth in some of those cities. And if you can see some of that, the double-digit growth in Perth particularly, that was a reflection of some of the capital moving out of Melbourne, particularly the investors, going over to the Perth city, and sort of you're starting to see that tight listing availability, and that's driving some of that growth. But we'll get to that in a second, why that may be a bit of a concern. So if we jump across the page, what do we see for 2025 in terms of interest rates? So as of, if you jump onto the ASX rate tracker, it's available to everyone to look at. As of the 20th of January, the market is anticipating a 73% chance of a cut in their first Feb meeting with the RBA this year, which is in a couple of weeks' time. I think that's actually jumped up to 78% chance. And then if that's not eventuating for the Feb cut, that will meet in March. So I think as James touched on earlier, the CPI, which is released for the December quarter next week, will be really, really important. I know Michelle Bullock will be having a look at that data to see, does that support a cut, or will she sit on her hands and sort of push out that decision later into the year? And then if you look at the implied yield curve throughout the year, as James mentioned earlier, there is the expectation there's a couple more cuts later in the year, seeing that interest rate trending down to sort of that mid 3%. And if you just turn the page, James. So, what will that do in terms of if we do see these rate cuts come through, particularly in February? I think it's definitely a mindset around if you see one or two in a rate cut cycle, it will do a couple of things. It will change people's mindset around, where affordability in terms of borrowing capacity goes. So if we look at it from a lending point of view, because every borrower, regardless if you're an expat or if you're in Australia, is above that floor rate. So the way it assessed is basically actual interest rate plus 3% is what you need to qualify for. So when rates are sitting at 6.25, we're now having to qualify for home loans at sort of 9.25 for that proposed debt. So every time there's a cut from the RBA, say 25 points, that increases people's borrowing capacity across the market, regardless if you're looking for your first mortgage or you have existing debt. And so that will start to, in my opinion, some of those markets, particularly in the first home buyer segment where, that property price is between that sort of 600,000 to 900,000, as the rates are dropping, people's borrowing capacity goes up, it allows them to bid up that property price band. So you'll start to see that money start to flow into those markets where supporting that affordability. And also when you're starting to see people looking at their rental, and we'll get to the yields in a second, but what they're paying current rent, if there's a couple of rate cuts, what does that look like in the proposed mortgage? And if they can afford that proposed mortgage, you'll start to see increased first-home buyer or owner-occupier transactions. And then just further to that, what we've seen around the fixed rates. So obviously on the back of COVID, everyone knows, and maybe some people on this call are still in some of those really cheap fixed rates, 2.5%. Once that was wound up on the back of COVID, those fixed rates jumped up to sort of 6.5%. We're now starting to see that 2 and 3 year pricing come down. So, for just recently, we're now seeing that 2 and 3 year fixed pricing below the variable rate, which has just changed quite recently. So some home owners, owner occupiers are maybe looking at partially fixing their mortgage and getting a bit of a deduction on that interest rate. So instead of taking, say, a 6.25 on the variable rate, they're now locking in sort of mid fives for that 2 and 3 year period. So that's starting to see a little bit more demand there, but still leading into that, about 90% of all mortgages were originated as variable because people were wanting to sort of ride the market and see what happens with the RBA. So if we just turn the page, so what are some of the expat lending trends that I'll see? So I think there's going to be more and more of an appetite, and I'm seeing this around not necessarily buying purely a property for investment, but it's more, I'm going to buy this property as investment, but that's with a future plan, perhaps moving into it with the family 2, 3, 4 years down the track when you come back to Australia. And I think there's a couple of reasons why. For some of our expats, their country they're in, they've overcome that inflation dragon, so they're on top of their day-to-day living expenses. They've got a strong currency because most of the currencies are pegged to USD, particularly in the Middle East. So they're getting a stronger borrowing capacity. They get their dollars going further back in Australia. So I think that's something that with that weak AUD, that's what is driving some of that demand. And people wanting to sort of reassess where they want to be long term. And that might be on the back of, what's happened in America, various reasons, but people are always reviewing that position. And then if we go across the page, Some other trends I'm seeing, despite the high construction costs, which are persistent in Australia, and I don't think the material costs on the construction is such an issue. It's just that persistent labour cost, and people talk about. I just think there's too much demand on a state level in terms of the projects that are pulling people away from resi projects, which is going to see. I think people are now understanding that construction cost is going to be high for a long time, but we're still seeing a high demand for that, and that could be renovations, small renovations, larger renovations, knockdowns, small projects, a duplex. There's still a lot of demand, and I think people are wanting to better utilise the land that they've got existingly, so put that to a better use. Expats are reaching out. I think on the back of COVID, people are reassessing their marital status. So I'm having to work with expats around that situation, how to sort of hold on to those assets, redo the mortgages, and also accessing equity for other purposes. That could be debt consolidation. Maybe they've got some debt they want to tidy up, or even try and access some equity to use in the country that they're currently living in. And if we just jump the page, James. So if we look at some of the property trends, so as I said earlier, Melbourne came back 3%, Sydney 2.3%. I think you'll start to see those markets pick up if those rate cuts do materialise, as affordability increases in those major markets. And then Perth, Adelaide and Brisbane all experience that double-digit growth. Again, I'd just be really mindful around Perth. A lot of that market is on the back of a strong mining sector, so it can get quite toppy. I know stories of investors coming out of the East Coast buying sites in Perth, sight unseen. So it is quite risky. You really need to do your due diligence. Even people trying to look at sort of house and land packages in Perth, huge labour constraints around actually getting those projects built. There's not that labour pool that there is on the East Coast, particularly in the construction. So you've just got to be quite cautious around what you're looking at there in terms of that transaction. And then Brisbane will continue to run past Melbourne in terms of the median prices. That's still going to continue to motor along. And then finally, if you want to look at, sorry, James, if you just want to go to the final slide. And then just looking at the rental growth across the board. So 2024, 4.8% growth, which sort of seems a bit more normalised if you look at that annualised trend on the right, where it was reduced from 8.1% in 23 and 9.5% in 22, which I think was sort of exploding on the back of COVID, and then obviously reflecting some of those higher holding costs for landlords. I think that will moderate this year, but from a net yield point of view, if rates are reduced in 2025, the net sort of take home for landholders will be sort of net similar to where we are today. So you'll see a bit more moderation on that rental growth, particularly if rates are starting to come off this year. And that is my slide, so thank you.
Thanks, Jeremy. And as we move into a bit of Q&A now, for those that are on the call, things to do, and a bit of self-promotion here. So we do run actually 3 podcasts. We run what's called the Expat Chat podcast. That's Brett and myself. And it's a bit like a fly on the wall, talking about different topics and case studies which clients have brought to us and examples. We also run the Expat Mortgage podcast, which is myself and Jeremy. And Jeremy gets some other professionals on there, buyers agents, lawyers, real estate agents, just to give us a really good read on different market pockets and what they're seeing. So we look forward to bringing you more episodes of that and rolling that out in February as well. On Facebook, we run what's called the Australian Expat Financial Forum. That's the name of our Facebook group. We've got just over 3,500 members, in there. Expats all around the world might have the same problems, or throwing in questions, getting clarifications from other expats that might have solved the issue, those sort of things. So if you're not in there, join there. There's some great things going on in there. We love seeing the community build on itself. We'll now move over to a bit of Q&A, and I've got some good questions that have kick-started us. I'll just open up. Looks like we've got 2 that have come through. Easy for this one. This one's actually for you, Ben. I'm going to flick it over to you. So I think this is regarding the foreign resident capital gain withholding changes come through. feel like you might have addressed this one already, but can it ever be varied down to 0% tax with the partial residence exemption? So I guess, is there any times that you've seen the ability to vary that tax down to 0%?
Mhm. Yeah, look, there are some circumstances you could vary it down to zero. So the first thing to be aware of is if you're trying to claim the main residence exemption, then that will typically only apply to you if you're a resident at the time of signing the contract. So by definition, foreign resident capital gains withholding probably won't apply to you at that point. Now, there are some circumstances though that you can apply the main residence exemption and still be a non-resident, but there are some serious life events like marriage breakdown or death of a partner or serious illness. Um, yes, you can vary it down. You really need to work at the capital gain based on all of your circumstances. And it's not just that, it's also your broader circumstances as well. So say you've been renting the property out for 10 years and you've got $200,000 worth of accumulated losses in your tax return. If you present that to the tax office and say, well, look here, I've got all these losses that will utilise in selling that property, then they will consider, even if there is a smaller gain, the utilisation of those losses in working out how much they can vary that down to. They're really trying to figure out how much tax will you really need to pay in the tax return that you are lodging for the sale of that property, and to the best estimate we can do, what should be the real amount, and that's the percentage that the ATO should approve.
Sorry about that. I was having a coughing fit.
Right.
Well answered there. Next question. I'll grab this one. Looks like it's targeted me. This is actually not something we talked about today. Throughout this year, we will be doing a lot of different webinars around different topics, retirement planning. We'll do some specific ones depending on where you are in country specific. So this one's mainly around superannuation. So James, will there be any big changes to super legislations with that $3 million tax rule? I know you didn't discuss it today. Was it a key change coming this year? Good question. So there was an announcement of what's called Division 296, where they wanted to tax large superannuation balances on unrealised gains for balances over 3 million. They were meant to vote on it in the Senate late last year, but it didn't sort of get put through or voted on. And given that we have an election coming through, it actually might take a back seat now. So that punitive tax measure that they're looking to put through on super might take a back seat for the time being. It's not to say it might come back in a different form, but that was one of the main scary superannuation legislation changes that was coming. I was worried because I know it impacted a lot of my clients, but not only that, there is a flow-on effect. It means all the big super funds, your big industry super funds, they need to now implement the technology to be able to work out the calculations and other things. So it was going to unfortunately have a negative impact within super, both from a tax point of view, but also probably from a cost point of view, fees going up, those sort of things, because of all these different calculations that super funds were going to have to run. So that was a good question there. I'll pause that one. Looks like another one here for Ben. If we sell our house as a non-resident, will the capital gains tax be offset against carry forward capital losses both my wife and I have, which are significant? Ben, are you comfortable answering that one?
Yeah, so the answer to that is absolutely yes, it will be offset, but the process is still the same. The 15% will remain unless you apply for the variation. So my recommendation in that case is to submit a variation and calculate how much of the capital losses would be used, and if that eliminates, or whatever the end result is for the capital gain multiplied by whatever tax rate you're likely to sit at, is going to be the withholding that will be required if any is left. So yes, you absolutely can apply capital losses and also revenue losses that have been rolled forward.
Right. I might give myself and Ben a rest. I'm going to throw this one over to Jeremy from Glenn. Interest-only loans, are they still a thing? And is it easy to get for expats? It's like I'm self-employed as well. So Jeremy, good question for you, mate.
Good question. Yep. So yes, interest-only loans are available. Not all of the banks will allow interest-only. They'll just only allow principal and interest, but there's still options out there. The self-employed piece is going to be harder to navigate because a lot of the mainstream banks won't accept that foreign piece, foreign self-employed income, I'm assuming. So yes, we can, there's still lenders out there that will accept self-employed foreign income. There is, but it's not all the banks.
Yep, good question. Good question there, Jen. Next one for Anonymous. I'm now a US resident and filing paying taxes here. However, my Australian account keeps filing my Australian taxes stating that I'm an Australian resident for tax purposes because they are worried about me overpaying tax. What's the right path here? I'm worried about an unexpected tax bill in the future. So in the US resident, but also being treated as an Australian tax resident. What's your thoughts on that one, Ben?
Well, I think you need to look at the residency rules, and if you are non-resident, based on the application of the rules, you need to be filing as non-resident. You shouldn't be taking, say, a conservative position. And it used to be the case that historically you were always paying more tax as a resident than a non-resident, but that's not always the case now, especially with the main residence exemption and the CGT discount, the way they work for non-residents. So it could be putting you at risk if you're lodging a return as resident when you're actually non-resident. So I'd strongly encourage that position to be looked at, and if it's incorrectly prepared, that it be amended. Now, normally you've got particular periods where you can amend within the last 2 years typically for individuals from the time that you received your assessment, but I'd be encouraging that to take place, because if the HO looks at your position and disagrees with what was put forward, and they can charge you interest and penalties on any shortfall. If penalties are probably not likely if you were using an agent and that was following their advice, but interest could definitely still be applicable if there was a shortfall that was, for a few years.
Good question. Next question here from Saif. So, is it a good idea to talk to you guys in the overseas work planning phase to ensure right structure is put in place for tax residency matters before moving overseas? So it is a good question. I think it's an easy one to work. If we have a bit of a lead time before you're moving overseas, it does mean we can get some things set up appropriately, especially if you might already have some different investment vehicles or tax vehicles, family trusts, self-managed super fund. I know that's a big one. Shouldn't be running an SMSF generally if you're moving overseas permanently and going to be over there for a long time. So if you are moving overseas, yes, you do want to engage someone with a team that can help you set yourself up correctly before you go. There's always going to be a bit of a mop-up just after you leave as well, and you've settled and you've got a new main residence, you've got a new, I suppose, lease in place depending on where you're moving to. But the earlier the better, just so you can be set up appropriately rather than a couple of years later. When I look at probably the different stages that our clients have engaged us, it's either before they've left, probably within 12 months, or they've been overseas for a couple of years, they're a bit more established, or they are returning back to Australia in the next 2 to 3 years, and they're just giving themselves plenty of runway to start looking at retirement planning, sending assets home, setting themselves up, all those sort of things. So those are the most common 3 stages that we see. But depending on where you're going as well, the country you're in, obviously there's some different types of advice that we can provide around that. So definitely want a bit of runway to help you prepare for a successful exit out of Australia. So that's good. Another one here, which might be more for you, Ben, but I might have a crack as well. We are returning to Australia from Singapore in the next Australian financial year. So that's the 2026 financial year. I understand there is a 6-month grace period on receiving and transferring our CPF, so Provident Fund, Central Provident Fund, after we are Australian residents. Is this correct? Ben, did you want to have a crack at that one, or?
Look, I'd need to have a look at the fund, but generally that is right. So I'd like to see the detail of any fund before I sort of comment specifically on it, but I think your understanding is correct in most cases there.
Yep. Yeah. These days, when you think about a foreign superannuation fund, not all overseas funds meet the definition that the ATO treats it. An easy example for me with a lot of clients in the US is 401ks, IRAs, Roth IRAs, they're not ordinarily meeting the definition of a foreign superannuation fund. So often they might not get that 6 months treatment where you've got that first 6 months to bring it home, and then everything after that becomes accessible by the ATO. So if you're unsure, then it's more important that you actually engage someone like Ben to actually give you advice. So that way you've got the planning down pat, you've got the advice, so that way you can try and time the withdrawal to keep it very clean and tax efficient. So good question there.
Yes. So on that point as well, look, there are some other options as well in relation to how that's repatriated. Sometimes it's draw down before you come back, if that's possible. Sometimes that's not possible to draw down before you come back. Sometimes it's a staggered withdrawal. It's about working out, even if it's not applicable under the foreign superannuation transfers, what's most tax efficient to bring that back in Australia, noting that we will normally allow a credit for any overseas tax that had been paid on that. So sometimes drip feeding it back to Australia in conjunction with potentially contributing that to super and using up your caps that are available becomes a quite efficient way and give you the same sort of result even if you don't get a straight transfer on this foreign superannuation rules.
Absolutely. Some final minutes there. For anyone that has any final questions, feel free to drop them in, anything you want there. Some bets on what the RBA might do as we finish off and come into the first decision for the year. The article that I mentioned before we were talking and we commenced the webinar was, I'm not sure if anyone's seen it, and it's regarding how the Trump administration might tax expats within the US and potentially levy an additional tax on them for not being a US citizen. So we talked about that briefly, and that did come up last night in our first session. I'm not sure whether Ben wants to provide any of his 2 cents on that one, whether we have the appetite for it or not, and what it might look like.
Yeah, I don't think I'm overly qualified to sort of give an opinion on that aspect. So look, I'd probably defer to someone who's got more of a finger on the pulse on that.
Yep. Understood. And in front of us today, the slides. So these will be sent out in the next 24 to 48 hours. If you don't follow us, feel free to jump on there. We do put out a lot of educational posts which link to articles, and it's the best way to keep informed when webinars are coming out, different seminars, those sort of things. So jump on Facebook, jump on LinkedIn, Twitter. Well, it's not Twitter anymore, is it? And Instagram as well. We've got another question that's just filtered through. So help me understand more about the comment there on 401k and the Roth IRA. Were you saying there is a mechanism to roll that into a superannuation fund without tax impacts? I'm happy to provide some comment here. Ben, you might also want to.
You start off and I'll fill in
Yep.
any blanks if I see any, mate.
Yep, no, easy. So it's a really good question. So you can't roll a Roth IRA or a 401k directly into a superannuation fund. They're almost polar opposite the way they're treated, one from the IRS and one from the ATO. A Roth IRA in the US, that's an after-tax account. You've already paid tax on the funds that have been contributed on it. And then if you are only a US tax resident, not an Australian tax resident, and you meet the required distribution age, you can actually withdraw it when you leave, assuming you're 59 and a half, and it's tax-free on withdrawal. Whereas the 401k, they're obviously usually through an employer. You've done a matching scheme, and they're mostly a tax-deferred account. If not all of it, it's usually a tax-deferred account. So the ATO typically doesn't treat these as foreign super funds. It treats it as some sort of foreign investment trust. That's probably the best way to say it, and Ben, correct me. And what that means is there is going to be probably some sort of taxation by the ATO when you do withdraw it. If there's withholding tax out on the US side, then some tax credits can be used, but it's best to probably seek some advice before you do that, whether it's before you come back to Australia or if you're back in Australia, just because there's been times where I've seen an expat's come back for a year and they've withdrawn 300,000-400,000 from their 401k without seeking advice, and then unfortunately they've copped a very large tax bill from the ATO because they didn't do any planning, because the assumption was made that it'd be tax exempt from the ATO side. So really important, but we haven't really seen a mechanism yet that you can roll a 401k and a Roth IRA into a super. It's also important to bear in mind that super right now, if you're still working, it's in accumulation phase. So it's being taxed concessionally at a rate of 15 to 10 to 15%, depending on the makeup, usually 15% on all the contributions if they're pre-tax going in, as well as the investment earnings income, those sort of things, 10% on long-term capital gains. And then when you retire, start drawing an income stream from it, that's when it's tax-free. All the investment earnings are tax-free. So very different to the US retirement system with the 401k. The Roth is a little bit different as well. So tried to answer that as best as I could. Ben, anything from you?
Yeah, so look, a foreign trust is how they're treated. So they're considered a foreign trust, and so the taxing point is when you draw down on those items. So they're considered initially whatever you draw down as being the taxable amount. However, there is some adjustments to that. So anything that you've contributed to build up the balance in those accounts reduces the taxable component. So say you have a $100,000 balance within your 401k, but that was made up of contributions of 75,000 and growth of 25,000. Then when you come to Australia, say you pulled the whole lot out, then we would only tax you on the 25,000 being the growth component, as long as you could prove the contributions of 75,000. So it's very important to have those statements available. Otherwise, the tax office would want to tax you on the whole 100. So that's how it starts. But then we also allow credit for the US tax that may have been paid on that as well. So that will reduce the Australian tax further. And if you also decided to contribute some to superannuation and use up your cap, so you could, in this instance that I mentioned, put 25,000 into super, and that would become a deduction. So that would then mean nothing would be taxable in your personal tax return. But you may not want to do full 25. You might want to do a bit less if there was some credits flowing from the US as well, from the tax return there. You need to be aware of what your caps are, and sometimes there's more than your standard 30,000 concessional cap available if you haven't been contributing in prior years. We need to really look through your circumstance, but we can definitely come up with a strategy to see what's sufficient in your personal circumstances and what is the taxable amount and what's not.
Great. Great stuff there, Ben. Another question here from Glenn. Jeremy, can you discuss a little bit about cross-collateralized properties and if they can be, assuming unwound easily? In Macau, and previous broker did a number on me.
Yeah, so, well, it depends on the bank. So I know that's a bit of an open-ended answer, but how that bank's credit department will treat it. If it's pretty straightforward, I would get, let's say it's two properties and your loan is, so cross-collateralization means you've got some debt and the bank's taken multiple properties under that one loan, as opposed to splitting out two loans against two separate loans, two separate securities. And the reason the banks do that is just, well, it may just be easier. There may not be sufficient equity in one of the securities. There may be too high risk, so the bank is comfortable just to wrap it all together. But let's just say it's two properties with one loan. If you get a valuation done on both properties and there's sufficient equity, you should be able to do what you call a partial discharge and then recut those loans to separate them out. If you're not selling a property, if there's not sufficient equity, and let's say you need to have it down at 70 or 80% LVR, to get it separate, you may need to pay down a portion of that loan on one of those securities to unwind them. Some banks, if you go down that pathway, and Glenn was saying self-employed, so that's probably something to be mindful of. If some lenders may trigger a credit assessment to allow that to go through. So for example, NAB will do that. They'll want to see financials. So if you're with a lender that does that and you no longer sit inside their credit policy, that could cause an issue where you can't actually do it. So it can be unwound, is the answer, but it really depends on the bank and how that specific bank will treat it.
Yep. No dramas. Okay. I don't see any more questions. There was one from Paula, but it was just regarding the AFR article that was put out about the way that the taxation might work with non-citizen expats in the US. So We'll send that out once the recordings go out because it's an interesting read. Might be behind a paywall, so let us know if it is. We'll just see if we can license the article or PDF it. Outside of that, if you are on the socials or on LinkedIn especially, follow our page because that's where we put out a lot of our webinars, a lot of events, a lot of initiatives as well. And another important one would be the Facebook group. That's probably going to do it for us from today. Really appreciate our co-hosts, Jeremy Harper, Ben Turner, and really appreciate everyone stopping in today and listening to us talk on. Hopefully we weren't too boring. And we look forward to bringing you more webinars and more information this year. If you do have any queries or concerns, please feel free to reply off the back of the emails that go out or come to us via the website. That's easy to address. Gentlemen, thanks for your time today. Look forward to carrying this forward.
Pleasure.
Thank you.
Thank you.